The new housing sector is facing a major crisis. It's caught between inventory, incentives, and prices. We're taking a very close look at what's going to happen in this podcast because builders are a fundamental part of the housing ecosystem. However, they've learned a lot from the last 50 years. They were one of the main factors and causes of the 2008 crisis. They had 10 years to fix all their mistakes, and then the pandemic hit. Along with the pandemic, a new crisis emerged. How are they handling this issue as we head into 2025? Are they making money? Are they losing money? Are they flooding the market with excess inventory that will hurt the chances of people being able to buy homes? Or are they offering so many incentives that it's actually a great opportunity to buy a new home? These are all the details you need to analyze because the builders, the main players in today's real estate story in the United States, are setting the tone. And we have some extraordinary numbers to help you decide whether this is the perfect time to buy a new home or if you should stay away from any kind of purchase right now. Additionally, we're going to take a look at overall price trends, review interest rates, and discuss the new forecast from Fannie Mae and other key players in the economy so you can understand where interest rates are headed and when that tug-of-war between the Trump administration and the Federal Reserve might finally come to an end. All of this, as always, with total and complete transparency, analyzing the sources, and knowing that this is the superpower you can have to make the right decisions when it comes to real estate. As always, I'm Gabriel Peroso, and I'm joined by my friend and business partner,
YENITZE. It's a great pleasure to be with you all today.
Jenny. We're now facing mid-year scenarios where the summer and spring buying seasons, the busiest times of the year, have already ended, and this time they weren't as attractive as in previous years. But as we're heading into August, how are we doing in terms of prices and market trends?
Yes, this year turned out to be completely different. Well, like everything that's changed since the pandemic, it's a new era, or let's say, it's a new market behavior that we have to get used to, and probably the metrics and statistics we've relied on so far don't really work for forecasting nowadays. What's happening with prices right now? For this, we've brought an article from Redfin, their weekly report, and it talks about the slowdown. The slowdown in price growth is good news for everyone, especially for home buyers. And a lot is being achieved because there's inventory coming onto the market. Let me read this to you. The average sale price in the United States is $403,000, an increase of only 2.2%. This price is the listing price at which the properties are put on the market. And the sale price, once the transaction's closed, is, let me check here, more or less, it has only increased by 1.6% year over year, compared to 5 or 6%. What I want to point out with these two numbers, you see units selling on the market, a 2.2% increase in price. Units closing, only a 1.6% increase in prices. This gap between both prices is shrinking, which tells me that many of the sellers of secondhand units are coming to market with a reasonable price, and that's why the difference between the listing price and the sale price is so small. Additionally, yes, there really is a noticeable slowdown in prices. Reasons, as we can see here, in 2024 there was a 5 or 6% year-over-year price increase, while today we only have a 1.6% increase. Where is the mortgage payment at? The monthly mortgage payment is at $2,679, which is the lowest level in 5 months. Why is that? Because, well, interest rates, although they haven't dropped drastically, have gone down a bit, and prices haven't increased that much. That has helped keep the monthly payment at this amount. Now, there's a very interesting metric in this article I want to show you, which is tourism activity. At this time of year, in 2024, there was a 20% increase in activity.
Let's talk about what this tourism activity is, Jenny. It sounds like visitors are coming.
Tourism activity refers to people who go to visit houses. In other words, it's about how people are behaving, going out, opening doors, and coming in to look at properties with the intention of buying them. So what's happening? In 2024, we have or had a 20% increase. Today, comparing the same period of time, it rises to 35%. What does this mean? There is a significant intention among people in the market wanting to buy units. What's happening is that obviously they're moving stealthily, like a hunter searching for its prey, looking for the best opportunity, and we can see that here in the increase in visits to the units. Now, if I go and look at what's happening with prices, this is at the national level. What's happening with prices in cities where the most drastic changes are taking place? I've brought you an article from the Wall Street Journal, and it talks about the 10 cities that have had or are experiencing the biggest drops in prices. And it's led by Austin, Texas, where we're seeing a 23% drop in the price of single-family homes. This article is referring to single-family homes. From what point is this price drop measured? In 2022, most markets hit a price peak, and this drop is measured from that peak. Austin, Texas, 23. Oakland, California, 22. New Orleans, 18. And so on, they keep going down. The one that's dropped the least on this list of the top 10 with the biggest decreases is Phoenix, Arizona, with 9%. If I look at year-over-year changes, leading the list is Fort Myers, Florida, with a 9.2% drop, which is here on the list at the peak with 10%. What does that mean? The Fort Myers market, from the most drastic change has happened from mid-2024 up to now. It's a market that started to decline at that point. And Oakland, minus 8.9%. Now, this is the statistic just for single-family homes. As we've said repeatedly, the same thing is happening with condos, and there's a very similar article that talks about 19 cities where condo prices have dropped the most. Here we have, once again, the top 2 cities leading the list. Oakland, California, with a 24% drop from the peak. Austin, Texas, with a 24% drop from the peak. These are then significant drops for those who bought in 2022, since losing or seeing the value of your property decrease by 24% is a considerable decline. Why is this happening? At the end of one of the articles, there's an analogy that we've always heard. What happened? Well, basically, interest rates dropped to 3% during the pandemic. It's as if money was being lent at 0%. At 0%, it's basically free money, as they say, when inflation was at 9%. Basically, low interest rates and the shortage of inventory caused all this price increase to happen. And for now, well, at the moment we're seeing declines in some areas. I know, Gabby, that you're here to talk to us about new properties that are also going through something similar.
Yes, Jenny. That effect we're seeing on prices that you mentioned is directly tied to inventory. We've talked about this ourselves on other occasions, and I even mentioned it to you before the podcast. There's an underlying factor in all of this, which is the lack of inventory nationwide over the past decade. It turns out that a lot was built from 2000 to 2010 up to 2009. Then the whole crisis came about, caused by poor management from the banks, but from that point on, construction dropped to minimal levels compared to the demand that should exist in the market. So we see that the underlying cause, or the biggest cause of all the imbalances in the housing market, is the lack of inventory. As we mentioned before, the pandemic hit. Interest rates were lowered to boost the economy, and the inventory was gone within months. What does that mean? There were very few homes for the size of the population, and this deficit still exists. It's said that there are around 4 million homes lacking in the United States. If these 4 million additional homes existed for the current population, we would have a cushion that would allow supply and demand to be much more balanced, because supply is very weak. In other words, whenever there's an increase in demand for any reason, whether it's demographic, economic, or whatever, the balance is immediately disrupted when it comes to the number of homes, the price, or the ability to access housing. And we also see this in the rental sector. Rents are heavily affected because they're expensive, since there are very few units available for rent. It's to the point that you often see a rental community, and as soon as it's opened or finished, it's immediately full. You think, but how is there so much demand that in 3 or 4 months, 200 or 300 housing units get rented out? Because there's a shortage. Normally, we should have about 10 to 15% of units unrented, or 10 to 15% of unsold units, which would serve as a cushion to allow for this. So we look at Austin, Texas, where there was a significant migration and where there are many economic factors behind the city, and we see how those prices drop, because any variation at this point caused there to be a lot of units in Austin, Texas, but not in other cities. If everything were much more balanced in terms of inventory, we could see that these imbalances wouldn't exist, or at least not so pronounced. When we go to talk,
And I wanted to add something. Something happened during the pandemic, and I think people felt the need not to miss out on an opportunity. And the opportunity is also, okay, inventory shortage, but those low interest rates made a lot of people overpay for properties, and that's also what's happening right now. A lot of people paid $15,000, $20,000, $30,000 over the market price for the unit, and that also caused this increase, and really quite a big one.
but the underlying cause is lack of inventory. You pay $15,000 more for a unit as it's the only one available.
Yes.
If it weren't the only one available, you wouldn't pay an extra premium. Inventory.
Right. It's the only one available, and I want to take advantage of the 3% interest rate.
I gave a client this example. I told him, it's the same thing as with masks or with vaccines. When mask prices rose during the pandemic, they were hard to get due to insufficient inventory for demand. Of course, those are unpredictable spikes for masks, but you should anticipate them for housing, as the housing situation is directly tied to population. In other words, there must be enough homes to accommodate the number of people, and we're running a deficit. So what happens? Interest rates go down, and I, as a son living with my dad, say, I'm moving out. Immediately, that home now has 2 family units living in it. Even if they're not 2 established households, it could be dad, mom, and a single child, and maybe the child isn't considered a separate household if that child has enough income and says, I see an opportunity with 2% interest rates, I'm moving out. But for him, that house should exist, built in an economy where homes match the number of people. So, these are the kinds of things that happen. When there's this split, people start saying, oh, interest rates are really low. I'm going to move out. I'll buy a house at the beach. I'll separate from the family. The lady who has a very big house says, I'm going to take advantage and buy a smaller house. In other words, all those housing moves get messed up when I don't want to miss the opportunity, but there aren't enough homes. If there were enough housing, the problem wouldn't be so serious. Obviously, it can happen because 2% interest rates aren't normal. But what's also not normal is that there aren't enough homes for the size of the population we have, not to mention immigration. The amount of immigration over the last 4 years that came in through borders and ports in the United States was very high. And those people also create demand for rentals and occupy housing that might not be accounted for in the census. Let's get into reviewing what's going on with new construction, since we've already spent half the podcast talking about just one topic. We see that home builders like D.R. Horton, are noticing that the trend continues with slightly higher incentives. Jenny spoke. Sorry. Jenny is going to talk about what's happening specifically with prices. What I want to do first is talk about how what's happening with incentives is or isn't affecting the builders. So, we're seeing that spending on incentives is helping D.R. Horton's home sales remain stable. What game are they playing? Let's make this a bit smaller because I don't think the whole chart fits. Here it is. What game are the builders playing? The builders are playing the game of offering incentives to keep sales levels steady, so sales don't drop, to help people, and to keep producing homes. But when we look at it from the point of view, look at this chart. This chart shows us in red all the homes that are under construction by D.R. Horton, and in blue, those that are in the order process, meaning they already have a signed contract. If we look at the anomaly that happened from 2002 to 2007, it was that many more homes were being built than were actually under contract, and all those extra homes started piling up. Then we see how there was a drop in sales, but even then, they always built a bit more than the number of contracts. That's normal. I keep generating more sales, I make contracts, and I move forward step by step. What happened after the pandemic? After the pandemic, since sales went up overall, builders constructed too much and ended up with inventory. How do they handle it? Well, they have houses at every stage. They have to get rid of them. They have to move that inventory. So they offered incentives. And here we see how there are far fewer houses in the pipeline. In other words, far fewer houses being built, but a lot more contracts coming in. That's D.R. Horton's strategy. But you might say, wow, now they have fewer houses, there are more contracts, these lines are going to cross again. It's all about balancing inventory levels. They can't see the future, they don't have a crystal ball, but they know they're responsible, and they know this can't happen again because it would be a disaster. So, when the first point happened here, they immediately cut back production and try to boost sales to balance the market again. We can even see here what D.R. Horton's orders looked like. In 2018, they had 14,000 homes in the third quarter. In 2019, 15,000. But by 2025, we're already seeing 23,000. In other words, D.R. Horton continues to have a lot of orders coming in, much more than during more stable times like 2018 and 2019. However, when we look at this by region, we see that there is a disparity between the areas. Not all regions are behaving the same way. And here we can see how they keep all the regions in a sort of balance and don't let any area get too far ahead or fall behind. Some have more, some have less. But D.R. Horton tries to even things out. And all the builders are playing the same game. With low interest rates, someone asked me, why don't they lower prices if interest rates aren't going down? Because when you lower the price, the impact of that price drop on people's monthly payments is less than if you help them by buying down points and lowering their interest rate. If I sell you a house for $400,000, it's better if I sell it to you for the same $400,000, but say, I'll take $10,000 or $15,000 from that $400,000 and give it to the bank so you can have an interest rate of 3.99 rather than I'll lower the house price from $400,000 to $385,000, but leave the interest rate at 6.5%. That translates into a higher monthly payment, and that's how the economy works, and you all know it. When buying a house, what will my monthly payment be? When buying a car, what will my monthly payment be? The price becomes secondary, and you focus on that monthly payment. Builders know this well and how to handle it. Then we look at the average price. You can see how from 2018 to now, the price, though increased, has stayed quite steady, stable between $398,000, $370,000, $378,000, and $369,000 at the contract level. Now, Jenny is going to explain to you how those incentives I was talking about affect the price, because here we see that the curve is very slight, but when we add in the amount of incentives, the curve becomes dramatically pronounced. However, people say, but the builders are struggling. The builders are in bad financial shape. Here we can see just how well the builders are actually doing. Now let's put this up on the big screen again, so it's easier to see. And here we see that D.R. Horton, for example, in 2005, had a 26% gross margin. That was their profit margin per home sold. However, we see that during the crisis, that dropped by about 10 or 11%. They never actually lost money, but the gross margin was very small. Here, they still had to deduct expenses and so on, and most likely, it was just breaking even. But when we look here, there's a completely clear anomaly in the post-pandemic period where they were making a ton of money. That is, everything they put out was selling, and on top of that, it was generating a lot of profit. Today, they're at 21%. They're actually at even better levels than during the stable decade, which was 2010 to 2020. That means the builder is not in trouble. On Thursday's podcast, where we'll be talking about Florida, we'll look at other players like Pulte and Heritage Home, who are also, in fact, not losing money. The important thing here is to see that the builder is offering incentives, but incentives they can afford. They're not putting their ability to keep building at risk. And finally, we can see exactly how the largest home builders in the United States have performed from 2019 to today on the New York Stock Exchange. The New York Stock Exchange itself has gained 95% since the end of 2019. Leonard gained 121%, D.R. Horton 191%, and Pulte 212%. The internal finances of all these home builders are great. The shareholders of these companies have made a lot of money. That means they definitely have much more margin to give. And now is the time to negotiate and to push. It's time to seek professional help. Go to these home builders and get the best deals because they have money to offer and they know they need to move their inventory and lower their buying barriers much more in order to reach interesting points. This is the situation with new homes. Jenny, how do we see this in terms of incentives and pricing? What do those charts look like?
Well, look, the market itself in terms of prices and especially for new homes has a lot of angles from which you can look at it or present the information. We've always talked about price drops. We've always talked about excess inventory. In fact, in this market, in this article, the first thing it mentions is the excess inventory. It says that the number of new single-family homes for sale at all stages of construction, that is, from those with just permits to those that are completed, totals 511,000, which is the highest level since October 2007. It's the highest inventory level we have, and you can see it here in the chart. It reached a level in months of how much? Of 9.8 months at the current sales pace. So you could say this market is on the buyer's side. And additionally, sales dropped 6.9% year over year. In other words, inventory is increasing, sales have dropped. They only have 54,000 contracts signed in June, and that's 1.8% lower than in 2019. Here I'm showing you more or less how the market looks in terms of inventory and transactions or sales that are being signed. But price, as Gabriel says. This chart is very important because we've always shown prices without including incentives. That is, we might see a discount that didn't look so significant, but once you include the incentive and the value of the product, of the property, we see that in this case, like with D.R. Horton, from before the pandemic up to the peak in 2022, there was a 41% increase in the value of their properties. And from the peak in 2022 to today, they've dropped by 11.1%, including the incentives. That is, this includes what they pay up front, also to lower the interest rates. This is regarding D.R. Horton. Now, Lennar, from 2020 to the peak in 2022, saw a 24% increase in their prices. And how much has it dropped? 19.5% as of today, including incentives. But as Gabriel said, despite this drop in price, their profits are still significant, and they still have plenty of room to offer even more incentives or manage the market in such a way that it doesn't turn into a crisis for them. We can see that they're doing just that. In last week's podcast, we talked about how they're reducing the number of permits issued, and in the long run, they're going to, in some way, slow down the production of inventory. They're not going to stop building, they'll keep building, but in some way, they're going to create or adjust the business model so that it remains profitable for them. Obviously, the profit is maintained, and notice how they've adjusted prices quite significantly. All of this is tied to interest rates. I know, Gabriel, that you always have comments about interest rates, where we stand today, and well, soon we'll also talk about some forecasts.
Yes. Before we get into interest rates, I'd like to talk a bit about the future of new home construction and an analysis by HousingWare that I think is quite accurate because they're not just looking at it from the perspective of new homes for sale or under construction, but also from the standpoint of the labor force. Because there's something interesting. For the Fed to lower interbank rates, which is what the Trump administration wants and is pressuring the Federal Reserve for, and I mean, really pressuring them hard. We're seeing that for that to happen, the labor factors in the United States have to break down. In other words, unemployment has to rise. There needs to be a certain level of recession in the job market. The Fed sees a very strong labor sector, but remember that one of the main factors in the labor issue is construction. Construction employs a huge number of people, and as long as construction isn't suffering, you don't see the recession. There's an interesting chart that shows how residential construction is doing in the United States and how this chart looks since 1990. Each line you see here, this line represents a recession. Recession of the 90s, the dot-com recession at the start of the 2000s, the housing bubble recession in 2008, the COVID recession. Notice how normal it is that before a recession, there are a lot of layoffs in the housing sector. And here it seems like there aren't any layoffs in the housing sector. But you say, what happens if, when we look at the numbers, we see that there are 627,000 homes, according to census estimates, and there are 120,000 homes that have been built but haven't been sold? Shouldn't the builders be reflected in the number of workers and start laying off workers because they're not going to keep building? That doesn't seem to be reflected, and it's something the Fed expects, because it's normal that when it looks like bad markets are coming, the Fed sees unemployment rise because there are a lot of layoffs in the housing sector. But here we see that inventory goes up, months of supply increase, the number of sales goes down, median home prices drop. So when are people in the construction sector going to get laid off? That doesn't seem to be happening. Why? Because we're seeing three factors here. Builders already made labor adjustments in 2022, which is what Jenny was talking about. We had a peak in 2022, and the adjustments were made 3 years ago. In other words, the construction sector already let people go in 2022. Those people found work elsewhere, and it doesn't seem to be reflected in the labor market. Second, we have 119,000 finished homes available for purchase, but there are another 119,000 under construction that haven't started yet. In other words, the construction companies remain optimistic and say, I have a lot, I have the same amount left to do, But I don't want to lay anyone off because interest rates might go down, and it would cost me a lot to rehire those workers who are already trained. They're holding on a bit longer to see how far they can go. And how are they holding on? Also, because there's a lot of labor in the remodeling sector, since homes in the United States are becoming obsolete at a very high rate. There are many homes built in the 60s, 70s, and 80s that really need a lot of remodeling, and they're absorbing the workforce. What does that mean in practice? It means that, in effect, the Fed isn't lowering interest rates, and we're still seeing fairly stable rates at 6.81. However, that thing Trump wants, insisting that interest rates actually go down and putting brutal pressure on Jerome Powell. Now they're opening investigations against him for corruption issues. This week, unexpectedly, we saw Trump meeting again with Jerome Powell, precisely because of the Fed's renovation projects. The Fed is moving forward with renovation work, and investigations are being opened to see if Jerome Powell is committing any kind of crime with these projects, which amount to $2.5 trillion. It seems like an exaggerated amount just to renovate the buildings. Congress is opening an investigation. They requested a visit, and surprisingly, in addition to members of Congress, Donald Trump himself showed up at the construction site to talk with Jerome Powell and hold a press conference right in the middle of the renovations. All of this just to tell him, you have to lower interest rates. Jerome Powell remains stubborn on the issue. It doesn't seem like there will be a rate cut at this week's meeting. There's talk that possibly in September, with a 50% chance, he's waiting for the employment factor in the United States to take a hit because of the tariffs. But it seems like we're still far from that. Neither the housing employment sector, nor the industrial employment sector, nor the services employment sector, and additionally, the tariffs seem to actually be affecting inflation as much as was feared. So, there's a struggle between inflation and employment. Jerome Powell prefers to just sit back and do nothing. Let's see what ends up happening as the year goes on. However, how are those forecasts looking? Yenny forecasts. We're at 681. Not bad, but we could be doing better.
Look, most of the forecasts are 6.4, 6.4, 6.5, 6.7, 6.5. Basically, it's going to go down a bit, but nothing major. We'd say everyone is waiting for interest rates to drop significantly, but what we're seeing for the end of this year is that they'll stay about the same, maybe a quarter point lower than where we are now, but nothing extra. For 2026, waiting in the low sixes. Those are the forecasts from NAR, Realtor.com, Fannie Mae, the Home Builders Association, Freeman, and Morgan Stanley. Really, what people think is that we're in a period of stability when it comes to interest rates. And as Gabriel said, Trump is doing everything he can to try to lower interest rates, but somehow the Federal Reserve doesn't see the characteristics, the CA, the factors that the market needs to show for this to happen. And as a result, we're basically going to have the same interest rate. That's why it's important to remember that these interest rates are set by the market, yes, but they're also directly related to your financial profile. The better you prepare your financial profile, your debt-to-income ratio, your down payment, your credit score, which is so important, the more we can make these interest rates work in your favor. So, I'll wrap up with this advice. These are the forecasts, and the forecasts don't predict a significant drop in interest rates, but you can do your homework and prepare yourself, and with that, find the best deal, the best interest rate, so you can get a lower monthly payment.
That's right, Yenny. As real estate agents, we're here to learn everything that's happening in the market so we can take full advantage, whether you want to invest, buy a home to live in, or rent. We're always here to help. Thank you to everyone who trusts us and knows that we are real estate agents fully committed to transparency and the numbers. which in the end are what ensure you make a good real estate transaction. Don't forget to give this video a thumbs up. By doing so, you let the platform know it's quality content that should be shared. Additionally, share it if you know someone who might be interested. And of course, subscribe to our channel. We have 4 podcasts a week with the best of real estate in the United States, in Florida, and of course, our podcast always bringing you financial information. Many thanks to everyone watching us on behalf of Where to Live in Miami podcast, a creation of Invest in Miami Real Estate. Total transparency.